Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Steve Harris of Committed Capital to talk about their Growth EIS Fund. Hello, Steve.
Good afternoon.
First off, just give me a flavour. What is the Committed Capital EIS?
So Committed Capital EIS is a growth stage, technology-focused UK EIS fund. And classically what we're trying to do is to provide investors with the ability to have exposure to 8 to 12 companies within the portfolio. And we say within a period of 12 months, although historically we've deployed cash typically in 4.5 months.
Tell me about Committed Capital and also a bit of background about yourself.
Yes, so Committed Capital was founded in 2001. And I was part of the original team asked to manage that business. And much of the team remains intact. And we've always done the same thing, which is growth stage technology investment in the UK markets. In the early days, we did some international business as well. It's now purely focused on the UK. In terms of my background, so I was at London Business School. I'm ex-Army some time ago and worked for 2 investment banks, HSBC and SocGen, corporate finance, a consultancy where I headed the M&A business, PA Consulting, and I helped set up a company called Ant Factory, which is a $600 million investment vehicle in '99 for early stage tech investment. And I've been running Committed Capital since leaving that.
So tell me, what are the sort of characteristics of the companies you're looking to invest in?
So at a very high level, what we're looking for is encapsulated really as follows. So first thing is the underlying markets the company may serve will be substantial and global and fast growing or changing in ways that we feel we can leverage. That's first thing. Secondly, the company itself has to have a product that is in the market and proven. So we're looking for companies with a turnover of at least £1 million, so we can look through the company, talk to some of the underlying customers, check the efficacy of the product, look for gaps and so on. And then the final bit is this difficult area of product market strategy. So having said that, obviously we're looking for an excellent team and a team that can deliver on the question of how best to get the product into the market.
Do you want to give me some examples of recent investments you've made?
Yeah, so this year we've been unusually active. So we've made 12 investments and we've done 1 EIS exit and 1 exit out of convertible. So one example would be an edtech company called Cortext. And what Cortext does is it provides a platform under which universities can receive digital textbooks. So behind that there are something like 1,400 license agreements with individual publishers from Pearson, McGraw-Hill at the top all the way down to those small publishers with 1 or 2 publications. And so what Cortext does is it provides universities with a complete suite of textbooks and analytics for the university professors to understand the performance of their individual charges, the students. So this year it's a £6 million investment into Cortext.
What made you invest in it?
EdTech obviously is a massive global market. EdTech materials probably is about 14 or 15 billion, something of that sort. Interestingly enough, we looked at the UK market and discovered that for conventional UK courses, university courses, only 0.1% of those courses had digital textbooks. And quite clearly the market is going in that direction. Students were saying, sort of a big sort of student review, in which the students, 92% of them said, why am I carrying all these books around? And we're talking about 2014. So absolutely outstanding team who have created a very similar business in the US, which has been hyper successful. And so it's that combination of big market, changing very fast, very, very good underlying product, great team of technologists, and where we are today is having started with them in 2014-15, with really no traction in the UK market. They're now in, I think, 108 universities in the UK market, and in the UK there are only 162 universities in total. So, which then brings on to another piece, which is what we describe as crossing the chasm. So we like our companies to focus on one geographic market or vertical before benefiting, if you like, from penetration of an international market. So they start from a firm base and then they use that to develop.
Mm-hmm. And tell me about other recent investments.
One other company we invested in at the beginning of the year, Q1, which, if I'm being candid, was needed some cash, fairly urgently. So we invested 3 million into a company called Cloud House, which is a technology business that provides the software for the virtualization of computer applications. And you'd think that was a market that's well served, but the issue there is, again, it's a very substantial market. So we're talking about globally, it's an $80 billion market. But what they identified was that the existing suite of software out there doesn't allow, if you like, troublesome apps to be virtualized or pushed up into the cloud. So the result of that might be, for example, a doctor going out to see a patient and finding that he can't download the patient's records to his iPad because he can't, in turn, the NHS has been unable to upload those details. So we invested in that company. As I say, they were short of cash in Q1. Successful fundraising, slight down round, and they subsequently concluded a $24 million contract with a very substantial US technology business. And so, very successful outcome.
How involved do you get in these companies?
Yeah, that's a great question. So we're called committed capital. So the idea behind that originally was the commitment largely related to support. So in other words, outside of financial investment, the support we gave to companies. So I guess we are very, very involved in these businesses, and there are lots of different circumstances. So the whole business of governance at the outset, setting all that up in the documents, is, I think, relatively standard. We'll then do an additional piece of work, for example, on remuneration. So remuneration is largely in this sector not logical or coherent. Very often small companies take on one person on one set of terms, another one on another set of terms. In the end, you can't manage that. So what we'll do is work with them to set the basis of salary, base remuneration, bonus schemes, options, and tie them back into our collective view of the main levers for growth. And it tends not to be that complicated. Very often it's units sold or it's sales. So that's a piece of work. I think it's Paul Romer, so the Nobel Prize winning economist, who said, never let a crisis go to waste, which brings us then on to another piece, which I think probably does distinguish us from other companies in the sector. So what you find, which I guess you'll know pretty well too, is that from time to time these companies will, very often through no fault of their own, run out of cash. And then there's a crisis, there's a question over solvency. And the question for us is, what do you do at that point? So what we tend to do is be absolutely as supportive as we possibly can, go right out, if you like, on over the backsides, over the transom, that's the right term, to support these businesses. And so what we've developed is a kind of 4-phase methodology for turning companies around where there is a question over solvency. And the phases essentially are: 1, analyse, understand what's happened, what's gone wrong, and if there's somebody responsible, should that person continue at the business? Then 2, cost review, because clearly part of this crisis, if it's a cash crisis, come out of an imbalance between revenues and costs. And the cost review may result in a reduction in overhead costs of 30-40% sometimes. 3, review of product market strategy. Clearly the company hasn't sold the products it should have done, and so we'll work through that. We often put together a paper on product market strategy with the team, and it's iterative. As the market starts to reveal itself and unfold, that will change going forward. And finally, if all of that is fine and ticked off, then we'll infuse the company with more cash. What we've discovered over a long time of doing this is that, having gone through that process, most, if not all, of the companies that have been through that then suddenly have a new lease of life and take off and do some really good things. I mean, it's quite key, I think, because the most wasteful thing I think the venture capital industry in the UK does is step back in a crisis. If you think that your investment thesis is correct, even though there's been a problem, there's no reason why you shouldn't support that business and see it hopefully go forward, develop, flower, and make investors money.
And what are the challenges you have as a manager? Is it, for example, hard to get deals? Are you having to pay too much?
Yeah, that's a really good question. I think there are various challenges. The market is just a fascinating one. I've been investing in tech since the 90s, and I've never seen a market quite like this. Every year that there are more verticals, demanding tech investment. There's more going on. Technology has insinuated itself into every company, every sector. More good young entrepreneurs coming through and more seasoned entrepreneurs. So I think that we see probably 700 deals a year, and the question is then winnowing them down to a manageable number, and then managing this sort of business of follow-ons versus new investments. That's key. So I think there are. As the business develops, as our business develops, then one of the bottlenecks is just the hours in the day. Last year, clearly we were working hugely long hours to get everything done, and so growing into that's important. And then capital is the other thing. I think one of the challenges from our perspective is that we do things slightly differently, and many of the people at Committed Capital have been there, and I've been there since 2004. Some of my colleagues since 2004, 2005, and so there's a lot of ingrained knowledge around the processes we use, and so the challenge is always bringing somebody in and them quickly picking up the way we like to do things and running with that.
Have you had any exits?
Yeah, we've done lots. So we've done 33 EIS investments, 19 complete exits, 2 partial exits, although by partial I probably mean we've sold 70 to 80% of our stock and kept in a small line of stock as well. And it's been a good experience, I hope, for our investors in that over time we've returned about 41% a year, gross, but not taking tax into account, and it's sort of 2.5 to 3 times your money. And the average hold period has been around about 4.5 years, something like that.
Okay. And failures?
Depends how you define failure. So we haven't had any companies that have gone bust on us for reasons I've just sort of outlined, I think. We had one exit where we exited at below the aggregate value of investment, and it was about 30%, I think. So to the extent that investors had availed themselves of EIS benefits, then they were in and out at the same price. We're very happy with that, and I think it is partly systemic. Or rather driven by philosophy, the way we do things, which is that if we think a company is a sensible investment at the outset, then probably 1 year hence or 2 years hence, if there's a problem, it still is a good investment, but it might need some rejigging.
Final question. I want to put some money in an EIS fund this year. Why should I choose you?
I think so we are, to an extent, say boring, but I think focused is so we've only ever done one thing, which is to invest in growth stage technology UK businesses, and track record has been very strong, really. I mean, since 2001, 41% a year is good enough, and we aim to get 25% a year. But clearly, that's not a forecast. So I think the reason probably for investing in us is not. It might, the track record will form part of it, but really what it is systems, is the systemic aspect of what we do in terms of the 2 areas, one being search and selection for companies, and 2, the very important business of custodianship, and within that, adding value and hopefully preventing companies from falling over. So I think that's it.
Steve Harris of Committed Capital, thank you very much.
Thanks so much.